All right, guys, welcome. Thanks for joining. It is Friday, August 23rd. Friday, the day that we usually let options expire or we have to roll them. It's an exciting day. I'm going to go over my positions. Just to kind of give you a quick rundown on this channel, the point of this channel is to grow it very, very slowly in a safe way. We do not do these YOLO option plays. We do not do things that will completely wreck your portfolio. So we are very diligent with it, and we focus on the weeklies, monthlies, and on blue chip stocks. So follow along. If you have any questions, I'm going to do a quick portfolio review now, and then at the end, I'm going to go into the Q&A. Okay. Just as a precaution, I do personally do with a very small portion of my portfolio do some a little bit more riskier plays. I will specifically point those out. Okay. So let's dive in. What's kind of happening? Let's talk about that real quick. What's happening? So right now the market is reacting to a couple things. First thing is we had the DNC Kamala Harris speak yesterday for the presidential race. It seems like the market is not really reacting to it. I think right now we're kind of on a short-term bullish run until September rate hikes. There's about a 90% chance that rates do go down, estimated about 25 basis points. Right now, 25 basis points is irrelevant in the grand scheme of things, but it does signal that the Fed is now on a trajectory to start reducing them further and further down the year, as long as inflation remains under control and remains trending towards their long-term 2%, right? So a lot of gibberish there. Pretty much what that means is interest rates are going to start going down. It's projected to start going down in September. The market loves it because what it means is that it's cheaper corporate debt for companies that are either in debt, and usually it means an uptick in economic activity. So that's kind of the gist of what's happening right now. So let's get into it. So right now, the account was started with about 150,000. Right now, we're getting close to the 200. We did touch 200 earlier this week, but the market gods did not allow us to have it. So we have to fight to keep it. We're getting close. A lot of this portfolio is in Tesla. I'll go over that position shortly, but let's go ahead and get started. So CleanSpark, right? CleanSpark is a position that I've been selling puts on, and I got caught on a pretty ugly put at $17. I got assigned. So what I've been doing is I've been trying to wheel myself out of this position now for some time. My adjusted cost basis, right? So if I take up all the premium I've made and I added, the reality of my basis for these shares is somewhere between $13.50. So my goal when I get into these scenarios, my goal is always to try to lower my basis to a position where it is lower than where the market is. And then at that point, I make the decision to either just get out of the position completely, or just to keep using the shares that I have to create more income now that I already have the shares. But I have to be very secure about that position to keep it. So keep in mind for this CleanSpark, my adjusted basis is $13.50. So we are almost there. I have a few positions open on CleanSpark. I actually just closed yesterday, which I should have just let run, but I had about 20 puts open that I had open for, I think I made $200 or $300 on this position, but I closed them for 2 cents yesterday. That is a personal thing that I'm kind of trying to fight against, which is, if the position is very safe, I just try to close it. That's a good idea when they're risky positions. When you get to 50, 60, 70% profit, just close them out. But if it's a put, if it's at $11, there's a day left, and the stock is at $12, you might as well just let it run, right? So that's something that I'm trying to personally do. I've got 4 12.50 calls and $13 calls that are both expiring today. I think these will all expire worthless. We're at 12.14. It's already up 2%. I don't suspect it. I don't suspect CleanSpark to make it past 12.50. So for this position, I'm pretty good into it. I'll leave this one till the end, just because this is one of those risky positions that I'm gonna specifically call out. Palantir. So with Palantir, I've been doing kind of it's a very small position, but it's what you call a premium grab, which means that if you think the stock is going to go down, you sell an option or you roll it down, right? So you roll down the strike price and it captures all that premium from where the stock is to where it is. And I thought that Palantir was going to correct. I think it had gone up a lot. Obviously, it's still printing. So right now I have an average of $27, almost $28 a share. I only have one bucket, so 100 shares. I rolled it down from a 30 to a 29 to capture that premium. And what I'll probably do, and I do still believe that this stock is just went up way too fast. It's a phenomenal stock, and I do think there's a lot of potential with this stock. But I think short term, it's going to have some correction into the high 20s. So look, if you look at it, I opened this in 816 and it's gone up like from 30 to 32, and I'm really not down that much. I'm still $5 in, right? So what I may do with this position is I will see if I can roll it up again till 30 for a credit, or truthfully, I may just roll it out again another week at the 29. I'm going to let this run till this afternoon, and then this afternoon I'll go ahead and make that decision. I believe, just to give you a quick idea on Palantir, I think they're a phenomenal company. I think the people behind them, Alex Karp, huge fan of Peter Thiel. I think the people behind them have a very long-term vision. And if you've ever read Peter Thiel's book, 0 to 1, he likes ideas that are transformational. And I think this company is transformational. They're one of the big players in the AI space, and not just the AI space, but the defense AI space, which is a very hard industry to penetrate. And I think they've been able to do it. So now the question is, can they monetize it? So I also sold a put on Palantir at 29. Honestly, I'm okay acquiring anything under $30. So I sold this put, nothing crazy. Where is it? It was a very small position. I mean, I sold two $29 puts, so that's $10, nothing crazy. But what I do like to do, and the reason I did that is whenever I have a call or I sell a call, I like to sell a put around the same strike and the same expiration date. So that way I have a guaranteed winner, right? So if I sold a $29 call and I have a $29 put, if it's above $29, then I just got to roll my call, but I banked all those puts. But if it's below the 29, I banked that call premium, but now I got to roll the puts. So it guarantees you a win. That's a little strategy that I enact. That's Palantir. Riot. So Riot is another one of those Bitcoin miners. I truthfully, I try to stay away from Bitcoin. If you're going to trade Bitcoin, you might as well just trade Bitcoin. But Riot, through my friend TJ, the wheel deal, I've learned a lot about it. It's a pretty strong company. So I started to sell some puts on it. I made $100 here. So nothing crazy. I'm going to let this one run and just expire worthless. 750. It's up till 8. So I'm not concerned about it. Let's go into SoFi real quick. SoFi is one of those positions where it's my second largest position on the platform. I've done very, 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 very good with it. Average cost 74. I've actually reduced my positions. I used to have 2,500 shares at one point. I've been reducing them. Even though I think this is a phenomenal interest rate play, I think once interest rates do go down, this company can hypothetically go through the roof. It is considered a bank, and it's actually one of the fewest banks that has almost close to zero commercial real estate exposure. And as many of you know, I am in the commercial real estate industry, and it is a bloodbath around the country, specifically in the office market. A lot of big office buildings, those massive high rises you see in cities are getting massive valuation haircuts. Things that used to trade at $200-300 million are trading now at 50, 40. So it is good that this bank has close to zero commercial exposure. What's going on here? So I sold a few 750 calls. We're at 721, so I should be good with those. I sold some 7 calls as well, and then these 650s expiring next week. I'm just gonna let these run. Not too sure what I'm gonna do with these, but these 7 calls, I may just roll them out again to 7 calls, and just keep collecting that, keep collecting the premium until I eventually just let go of them, or I'm going to see what it would take to how far out I need to go to get them up to 750. $7 puts, I sold these for next week as well. I may even add to this position, to be quite frank, just following that strategy of guaranteeing a win. But, this is $180 of premium. Got them at 11. They're worth 9 now. I may do it, depending if SoFi goes red, I may do it. Tesla, I'll do Tesla at the end just because it's my biggest position. American Airlines, so I got burned with American Airlines. I was selling puts at 11 when it was at 11, and I got caught. Thankfully, based on the premium I've collected before, I was able to sell them at $10.05 out of gain. Even though I lost a lot on the share value because I had collected so much premium on the covered call and put side, I was able to cut my losses at a point where I felt comfortable. I do have a long-term. I think long-term American Airlines is a very safe bet. It's one of the cornerstone American companies that even the government's not going to let fail, and we saw that in 2008. So it is a safe bet. I think travel starts to pick up in December. I think now for Thanksgiving, Labor Day, it's going to be a pretty good play going into January. So I started to sell puts on it again, $120 for next week. I got collected $13. I may add to this position if this goes red. So we'll keep an eye on American Airlines. It's just very volatile, but it seems like if you look at the chart, it seems like it has a pretty good support at these levels. These are all-time figures. If you go back to COVID, right? So when COVID, this is COVID right here, when it was basically predicted that they would be flying 0 planes, it went down to $9.04. And you're telling me now they're at $9 and what are they? $10.30, just slightly above it. That's a hard pill to swallow. So I do think that these are pretty low levels to be buying American Airlines at. All right, Amazon. So this Amazon play is an interesting one. It's a play on the Portman covers call where you buy a call and then you sell a call on it. I'm experimenting with it. I like to do them on I haven't really gotten a grip on that strategy yet. So I try it with smaller positions. So for this particular position, I bought a $30 call on AMZU, which is a 2x levered Amazon play. And, I bought it for 590. I sold a call for, I believe it was like 200, 150, 180. That expired. And I sold another call on it for actually, that was the page. And then I sold a $33 call on it, which I haven't made much credit on, but the idea is that ideally I can sell the call at a profit and use the calls to minimize my basis and make a pretty good return, because your premiums from your calls, if you look at it on a percent basis, are based on your cost basis for the call. So when you look at it that way, it makes a lot of sense, right? And what I mean by that is, if I was to look at this position, right, I paid $590, but I sold this $33 call for $80. That's a 13.5% return, right? So the returns are very strong as long as the call position doesn't lose its value. So that's why the underlying asset does need to continue to go up or stay more or less where it's at. So I think the key with these poor man covered call is to really buy the stock or buy the call in the money so that there isn't a lot of theta decay, and trade it for a certain period, selling short dated calls on it, and then eventually sell it before it expires to still capture some of that implied volatility. I think that's really the sweet spot for those poor man cover calls if you want to make money on them. Okay, cool. So I'm just, checking that one out. JetBlue, again, another airline play. This was a play it's a very bullish play. So right now I bought this put in the money, which gives you a lot of premium. And the idea is that by this date, if it's out of $5, above $5, then you basically keep the full premium, right? So it is a little bit of a riskier play, but at the end of the day, the amount of premium that you collect protects you. You know, like I sold this in the night last week, and JetBlue hasn't really done anything, and I still could exit this position with a $5 loss, or not really. I could really try to exit this at cost basis. So I'm not concerned about this. I do think that, again, with the holiday season, it is going to do very well. Riot, I've got other $5 sells here, more puts just expiring further out. I think Bitcoin's going to do well through the election just because of how volatile it is. American Airlines, more puts. All right, I'll get into the Intuit at the end. Let's get into Tesla real quick, because Tesla is about 95% of this portfolio. So I bought Tesla when it was at 173. This 1,000 shares were acquired through a series of either straight purchases, or I had bought, call options that I exercised. But long story short, I got caught selling covered calls. And this is something that you have to be very vigilant in your portfolio, specifically if you have to be very clear on what your strategy is, right? Whether you're going to use the shares to produce income, or you're very bullish on the stock. And had I done this again, I perhaps would have saved either half or a quarter of the shares and not sold anything on them, right? But it is what it is. Let me go through my position right now. I've got a 205 put expiring today. Very happy about that one. I've got so this right here, these two paired, is exactly the strategy, the guaranteed win strategy that I was talking about. I have a 197.5 call expiring 8:30. So I sold the 197.5 call as well, because either one of those is going to be right. This was what, $111. So either one, I'm winning. I'll probably roll this call out, continue just to roll it out. Honestly, I mean, it's just, I'm not going to lose these shares. Tesla, $200 call and $205 calls. I had to really roll these out because Tesla just went through the roof. So I rolled them out to December 20th at 205. Just keeping an eye on these. Obviously the return on this premium is a lot, because I had sold these when Tesla was like at 240, 250, 260. So now that it's gone down, it's done good things for my premium. So I'm just going to continue babysitting these, to be quite frank, until either Tesla comes back down or I have to roll them out another year, which I'm fine with. At the end of the day, and this is something that we can talk about in another video. Actually, let me see. How much time are we in? Because I like to keep these at 30 minutes. We can talk. All right. So I think we are at 18 minutes. All right, good. So we got time. Covered calls in the water, and I always say this, are some of the best insurance policies against a shaky or a bearish market. And I'll tell you why. Because as long as the stock remains in the money, as long as your calls remain in the money and you defend them, meaning you keep an eye on the extrinsic and intrinsic value, so that you never get caught in a position where there's no extrinsic value and it's all intrinsic, so it makes sense for the other person to exercise. So you got to protect your shares. You have the ability to use time to keep rolling them out. And the key point here is that your income is going to come from the share appreciation, which is guaranteed because you're in the money, versus the premium from the call. And I'll give you a good example of this, right? So if I have these, let's go to my positions here on Tesla real quick. I have, oh wow, Tesla's ripping today. If I have let's look at this call right here, right? 197.50 call, right? So if I'm going to look at this position next week, then I'm going to be like, all right, well, what do I do with this position? I want to roll it up one step. That's my goal, right? So if I'm at 197.50, I want to roll it up to 200. I want to get to those $200. So if I roll it up to September 6th, I'm going to get 2,000, and I always roll for a credit. So 2,100, this is 2,200. So there's not enough premium here to make it a credit, which is fine. So we go out 21 days. And this one seems to be it, right? So here I'm making a credit of 25 bucks, which is nothing, right? But I am making, what is that, $250 in share appreciation. So 200 minus 197.50 is $2.50 per share, right? So $2.50 per share times 100. So I'm making $200 on share appreciation plus $200 on my roll plus $25. So that's 250 plus 25. So I'm making $275 on this roll. And this roll is adding 2 weeks. So in 2 weeks, based on my basis, which is 173, right? My basis is 17,350 per 100 shares because it's 173.50. So in 2 weeks, right, that is a 1.6% return in 2 weeks. That is still really good. If you annualize that, that's 1.6 times 2, that's 3.2 a month. 3.2 times 12, that's almost a 40% return. So when you are in the money, there's still a way for you to make money, but the money is coming from your share appreciation, not the credit not the actual credit that you're getting here. So just keep that in mind. And it's a great position to be in because I'm just eating away at Tesla, 200, and I can do this for the next year. And every time I'm guaranteeing myself 1%, 1.5%, 2% every time. So that's why I'm not concerned about my Tesla position. And again, you never know what happens with Tesla. We all saw that chart where it went up to 400 and it went back down to 160. Who's to say that won't happen again? Who knows? So at that point, maybe I cut my losses. There was a point actually very close to us that was already, I was already out of the money, we just go back a month. 1 month, it was at 191. So I was already out of the money, right? Obviously, I didn't close them out because there was still a lot of extrinsic value, a lot of time value left, and I wanted to just let them run. I'm in no hurry. So that is my position on Tesla. I also opened up some credit spreads, some credit put spreads. I'm very hesitant with this strategy because it can go sideways very easily. I'll do a whole video on this if you guys want me to, but I essentially only do put spreads, and I only do them if I have the ability to dismantle them. Those are my two key points with credit spreads. Now, the beautiful thing about credit spreads is that when you look at your credit versus your spread requirements or your margin requirements, it makes it a crazy return, like in the 20%. So that's why it's very attractive. I used to have 5 credit spreads. I sold 4 of them. I stuck onto one. I should have not sold them, but again, I'm very hesitant of them. Well, look, Clean Spark is already at 1250, so I may have to roll that other position. We'll see how it goes. Now let's go to this is the risky one. Okay, so this is the one that I'm talking about that I generally just do it with a very small part of my portfolio, maybe 2-3%. I played the Intuit earnings yesterday. So Intuit is the company that owns Credit Karma. They own QuickBooks. They own a lot of very good companies, and they had their earnings yesterday, which they beat estimates. They're doing a share buyback. They're doing a lot of very good things. The earnings were actually pretty good. I had bought a call. I bought a 690 call expiring October 18th. So I'm not necessarily concerned about this call. It is right now losing a lot of its value because obviously, Intuit is down almost 7%, which is crazy. So I have lost about $1,800. But, the reality is that I'm going to use this as a poor man cover call play. And I do think that Intuit is going to recover in the next week or two. So I'm holding on to it. I sold a 720 call on it for $200. This is obviously expiring today. So this is obviously, this is my second one that I have sold. So I brought in about $300-400 worth of premium by selling calls on this. So it does cushion the loss a bit more, but I really do believe that Intuit is going to recover. I think it's a phenomenal company. They have amazing cash flow. They have amazing, they have a stock buyback. But look, worst case scenario, if I lose $1,600, it's not the end of the world. It's not going to really affect my portfolio. So that's just a fun little play that we're doing here. That's pretty much it. My goal going into the Federal Reserve interest rate decision is to really eliminate a lot of my margin. When I got caught in these puts that got issued to me, I am using margin. I hate doing that because you're paying for this. So my goal is to I'm going to look at what's expiring this week and let some of them, that are in the money expire so I can get some funds and pay this off. I hate paying for margin. And my goal is to reduce the amount of option collateral that I'm going to be using. I want to get really low margin or even zero margin going into these interest rate decisions, because you never know if for some reason the Federal Reserve says, hey, we're not going to reduce rates in September, we're going to do them in November. The market will take an absolute dump. So we have to be ready for that, whether we like it or not. And the reality is that it's an election year, so it's going to be very volatile. And I don't want to have any margin when I do that. So that is my goal going into the next couple of weeks. But that's pretty much it. If anybody that is on right now, if you guys have any questions that I can help answer, I'm going to be checking my X now as well. If there's any questions, just type them out on the chat and I will address them. Otherwise, we'll go ahead and end this. Yeah, and I'm looking at some comments from Jerome Powell. He just said the upside risks to inflation have diminished and the downside risks to unemployment have increased. The time has come for policy to adjust. So they're pretty much saying that they're going to reduce rates. The question now is by how much? 25 basis points or 50 basis points? All right, so I'm looking here at my reduce rates. I'm looking at the chat. I don't see anything on here, no questions. So if I don't have any questions, I'm going to go ahead and finish the live stream. Thank you guys for watching. I'm going to try to do these at least once or twice a week. I think they're productive. Happy to go through any scenarios that we want to go through, any stocks. But with that, enjoy your Fridays. I'm always available via DMs. And that's pretty much it, guys. Thanks for watching.